Welcome to Topic 7, the final topic of ethics and governance. In this lecture, we bring governance and ethics together in the one place where they are tested most concretely and most visibly: financial reporting. Everything we have studied, boards, codes, accountability, integrity, ultimately shows up or fails to show up in the numbers a company reports to the world. So here we will see why reliable reporting matters so much. Meet the MFRS framework that governs reporting in Malaysia, and then confront the single most important idea of the topic: that merely complying with the accounting rules is not the same thing as honest ethical reporting. The textbook carries the full detail. Let us work through the ideas and bring the whole course to a close. Let me open with a question that genuinely surprises many students. A company can follow every single accounting standard to the letter, break no rule, satisfy every technical requirement, and still mislead its investors. How can that possibly be true? If a company obeys all the rules, surely its accounts must be honest. If that strikes you as a contradiction, then this topic is exactly for you, because resolving it is the heart of the lecture. By the end, you will understand that financial reporting is not merely a technical exercise in rule following. It is, at its core, an ethical act. And the difference between simply ticking the boxes and actually telling the truth is the whole matter of this final topic. Who governs financial reporting in Malaysia? Again, it is a system of bodies working together. The Malaysian Accounting Standards Board, the MASB, issues the Malaysian Financial Reporting Standards, the MFRS, which are aligned with the international standards used around the world. Auditors, guided by their professional bodies, then independently check that a company's accounts actually comply with those standards. Bursa Malaysia requires companies to disclose their financial results in a timely way, and the Securities Commission enforces the law against misreporting and fraud. And increasingly, a newer area, sustainability reporting, is being governed by international standards from the ISSB, the International Sustainability Standards Board. So financial reporting sits inside a web of standard setters, auditors and regulators, all aiming at the same goal: information you can trust. After this topic, you should be able to do the following: explain why financial reporting matters to investors and to markets as a whole. Describe the MFRS framework and a few of its key standards and principles. Explain, and this is the crucial outcome, why compliance with the standards is not by itself ethical reporting. And appreciate how standards, ethics, and governance must work together to produce financial information that people can genuinely rely on. We are ending the course by connecting the technical and the ethical, which is where this subject has been heading all along. Here is our journey through this final topic. First, why financial reporting matters at all. Second, the MFRS framework and a few selected standards. Third, the central lesson that compliance is not the same as ethical reporting. And finally, how standards, ethics and governance combine into one system. By the end, you will see financial reporting as the meeting point of everything we have studied across all 7 topics. Let us begin with the most basic question: why does financial reporting matter at all? Financial reporting is, quite simply, how a company tells the outside world the truth about itself, what it owns, what it owes, and how it has performed over a period. Now think about who relies on that report. Investors rely on it to decide whether to buy or sell shares. Lenders rely on it to decide whether to extend credit. Regulators rely on it to oversee the market, and the wider public relies on it too. Every one of these decisions is built on the assumption that the reported information is true. So consider the two possibilities. If the information is reliable, then capital flows efficiently. Money goes to the companies that genuinely deserve it, good businesses are funded, and trust in the whole market holds together. But if the information is unreliable, then decisions are being made on false data. Capital is misdirected to companies that only look healthy. People lose their savings when the truth emerges, and trust collapses. And once trust in financial information collapses, the entire market seizes up because no one can believe any number they are shown. That is precisely why reporting standards exist in the first place, to make financial information consistent, comparable from one company to the next, and dependable. Reliable financial reporting is, quite literally, the foundation on which trust in the whole financial system is built. Now, let us meet the actual framework that governs reporting here in Malaysia. In Malaysia, companies prepare their financial statements under the Malaysian Financial Reporting Standards, the MFRS, which are issued by the Malaysian Accounting Standards Board and are aligned with the international IFRS used in most major economies. That international alignment matters because it means a Malaysian company's accounts can be understood and trusted by investors anywhere in the world. Now, rather than memorizing hundreds of detailed rules, I want you to understand the spirit of the framework, which rests on a few core principles. One is appropriate revenue recognition, recording income as the company actually earns it by delivering goods or services, not simply when cash happens to arrive. Another is substance over form, reporting the true economic reality of a transaction, not merely its legal packaging. And another is prudence, exercising caution so that assets and income are not overstated and liabilities and losses are not hidden. These principles are not arbitrary. Each one exists for the same reason: to make a company's reported performance match economic reality, rather than match what management would prefer the numbers to look like. The MFRS gives every Malaysian company a common internationally respected language in which to tell its financial story truthfully. Let me mention a few specific standards just so you see how those principles work in practice. Standards on revenue tell a company to recognize income as it delivers on its obligations over time, not all at once the moment a contract is signed or cash is received. Standards on consolidation require a group to include in its accounts every entity that it actually controls, which is what stops a company hiding its debts in a separate vehicle off to one side, off the balance sheet. And standards on impairment require a company to write an asset down when its real value has fallen, rather than carrying it at an inflated figure to flatter the accounts. Alongside this conventional financial reporting, the newer sustainability standards from the ISSB now extend the very same discipline, honesty, evidence, and independent assurance to environmental and social information, which investors increasingly demand. Different frameworks, but one single purpose running through all of them: faithful representation of reality. Now we come to the central lesson of this topic, and honestly, one of the most important ideas in the whole course. So listen carefully. Here is the crucial idea. Compliance with the accounting standards is not the same thing as ethical reporting. Let me explain how a company can obey every rule and still deceive. A company can technically satisfy every standard and yet present a genuinely misleading picture by timing its transactions cleverly to flatter this year's results, by using complex but legal structures to obscure the real risks it faces, or by emphasizing the favorable numbers while burying the unfavorable ones in footnotes no one reads. In every case, no specific rule has been broken. How is that possible? Because the standards set a flaw, not a conscience. They define the minimum technical requirements, but they cannot, by themselves, supply the honest intention to actually inform the reader. Ethical reporting requires something more than technical compliance. It requires substance over form in spirit and not just in letter, an honest intention to inform rather than to impress or to deceive. And this is exactly the point where governance and ethics meet financial reporting and become inseparable from it. The standards, on their own, are just words on a page. They need honest people, an independent and competent audit committee, diligent auditors, and a genuine culture of integrity to mean anything at all. Without those, compliance becomes simply a more sophisticated tool for deception. Let me make this vivid with a contrast that sits underneath the whole topic: the tension between stewardship and performance. On one hand, management is a steward of other people's capital. As a steward, management has a duty to report faithfully so that the owners can see clearly how their money has been handled and can hold management to account. But on the other hand, management is also judged, rewarded, and sometimes kept in their jobs based on performance, on the numbers looking good. And there is the tension. The duty of stewardship pulls toward telling the whole truth, while the pressure of performance pulls toward making the numbers look as flattering as possible. Good, ethical reporting resolves that tension firmly in favor of stewardship. It tells the truth even when the truth is disappointing, even when honest numbers mean a smaller bonus or a hard conversation with shareholders. And when performance pressure is allowed to win over stewardship, you get exactly the manipulation and the eventual scandals that destroy companies and the savings of everyone who trusted them. So in one sentence, honest reporting is stewardship triumphing over the temptation to impress. Now, let me draw the threads of the whole course together, because this final idea is really its conclusion. This is where the entire course comes together into one picture. Producing financial information that people can trust requires three things working together, and you cannot drop any one of them. Standards provide the rules, the common, consistent language for measuring and reporting. Ethics provides the honest intention to apply those rules faithfully, in spirit and not just in letter. And governance, the board, the audit committee, the internal and external auditors, provides the oversight that keeps the reporting truthful in practice. Now watch what happens if you remove any one of the three. Rules without ethics become merely a checklist for clever deception, a guide to what you can get away with. Ethics without oversight is unverified, sincere perhaps, but the public has no way to confirm it. And oversight without standards has nothing solid to measure against. So, reliable financial information is never the product of standards alone. It is the product of standards, ethics, and governance all working together. That, in a single idea, is the whole of this course: structure, ethics, accountability, and reporting, all ultimately in the service of one thing: trust. Let me consolidate the key contrasts. Mere compliance ticks every box, satisfies every technical rule, and may still leave the reader misled. Ethical reporting, by contrast, tells the truth in substance and not merely in form. And the entire difference between the two comes down to intention and culture, enforced by governance. So whenever you look at any set of accounts, in your studies, in your career, or as an investor protecting your own money, learn to look past mere technical compliance and ask the one question that really matters. Do these accounts honestly inform me, or are they designed to impress me? That single question captures the whole topic. Here is our final topic on one map. At the center, financial reporting standards. Around it, why reporting matters, because it is the very foundation of trust in markets. The MFRS framework and its underlying principles of honest measurement. The central lesson that compliance is not the same as ethical reporting, and the way standards, ethics, and governance must combine to produce information people can rely on. And with that, the circle of the whole course is complete. Structure, ethics, accountability, and reporting, every one of them ultimately in service of trust. That concludes topic 7, and with it, our whole course on ethics and governance. Let me leave you with the final ideas to carry forward. Financial reporting is the foundation of trust in markets. When it fails, everything built on it fails too. The MFRS framework, aligned with international standards, exists to make reported information faithful to reality. And most importantly of all, complying with the rules is simply not the same as reporting ethically. Honest reporting needs ethics and governance, not standards alone. Please read the full chapter in the textbook for the detail and the references. Thank you for joining me through all 7 topics. Remember the thread that has run through everything we have studied. Good finance, in the end, is ethical finance.